You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Next on the agenda is Marc Odo. For those of you that don't know Marc, he joined Swan about 4 years ago. He kicked, cried, screamed when we dragged him over here from Zephyr Analytics. Marc was the director of research at Zephyr for 11 years, and so I had a relationship with him at my prior firm, and he did a lot of work for us. And then prior to coming here to Swan, he did some work, and we saw him, what he did with the white paper, what he did with his speaking engagements, and his ability to educate. He has an uncanny ability to take the most complex subjects and boil them down into the simplest terms to where just about anybody can understand them. Prior to that, he was a portfolio manager. What's that?
Including you. Yeah, help understand.
That's really difficult with me. Anyway, so Marc, I'll turn it over to you.
Okay, great. Well, thanks again, everyone, for spending your long day with us here. We're entering the fourth quarter. Promise we'll get you out of here by 4 o'clock. I got 2 sessions back to back. The second one's going to dovetail onto this first one here. In the second one, my colleagues and friends, Micah, Wakefield, and Chris Hausman, are going to join me up here on the stage. But in the, I'm sorry, and that's in the second one. In the first one, what we're going to do is answer some of the most common questions people have once they've heard the Swan story and once they've kind of considered the various things that we've been talking about here today. So maybe after hearing all these real great speakers that we've had and taking into considerations all the concerns people have about the equity side of the market and the fixed income side of the market, and then hearing some of these solutions that we have in play here at Swan with the defined risk strategy, maybe it's starting to resonate. Maybe you're thinking like, okay, the traditional model is not going to work going forward. We're going to need to do something different. And what Swan is proposing as that something different seems to make sense. All right, so maybe we've cleared those hurdles, but then the question that we often get is twofold. One is, well, where does the hedged equity fit within a traditional model? And then two, how much should it get? How big should the allocation be? And I'm just going to give you some ideas here. I'm not saying that there's any definitive answers. It's very true that the defined risk strategy is non-traditional. It's not easy to classify into a standard style box. So what I have are some different ideas on how you could potentially implement that into a portfolio. Now, the second session, the latter half of this, when I bring Micah and Chris up to the stage, is maybe the off-the-shelf solution doesn't work for you. Maybe the standard DRS, you like some of the things we do, but there's other parts where you're like, well, it's not a great fit. Well, what we're going to do is we're going to discuss some different customized bespoke solutions that we could potentially develop for you. I would encourage you to talk to all of us here at Swan and kick around what issues you guys are dealing with and how some of the ideas that we've shared here today might potentially be customized to fit in whatever it is that you guys are building out. But let's go ahead and talk about the off-the-shelf defined risk strategy first. As you know, there's essentially 3 primary elements to the DRS. There's 3 drivers of returns, or I like to say sometimes the 3 legs to the stool. You know, the first leg is the equity position. The equity position is very boring. It's buy and hold. It's the ETFs. It's a passive investment that's usually about 90% of our holdings. There's nothing really different than what John Bogle will tell you to do. Just invest passively, buy and hold through every market cycle. Well, of course, the flaw to that is that sooner or later, the bear market will come out of its cave. We are susceptible to major sell-offs if we have a buy and hold type strategy. So that is where the second stage of the process comes in, the hedge. You know, the idea of protecting against catastrophic risk on the downside. Well, even though we manage that hedge in what I believe to be a very cost-effective fashion, it will still act as a drag if we have, oh, I don't know, a 9-year bull market, right? We're not going to catch all of that upside. So what we have is that third piece of the puzzle, the premium collection trades, the income trades, which helps lay off the carrying cost of the hedge and helps us with our up capture and up markets. So those are the 3 different components here. The question is, like, well, twofold. How much should we add to an existing portfolio? And 2, you know, how do we put this into an existing portfolio? Those are the topics that we'll discuss here in the first half of the session. And we'll start off with this base case. The one that we've already kind of agreed with is under pressure here. This the standard 60-40 model here. Now, one of the luxuries of having a 20-plus year track record is we have a lot of data to work with. We've seen a lot in those 20 years. We've been through the dot-com crisis. We've been through the financial crisis. We've had the short-term shocks like long-term credit, the flash crash in May of 2010, this most recent event that kicked off 2018 here. So we have all this data to look at here and say like, okay, well, if we have this 60-40 portfolio and just looking at the straight math, just looking at this, the numbers here, if we put 10% increments to the standard 60-40 portfolio, how does that change the numbers? Now, I realize there's a lot of numbers here. I'm more of a pictures guy than a numbers guy, especially when it comes to presentation. So I've just highlighted in red kind of the sweet spot with all these various different metrics here. So obviously, because our return has been very good over full market cycles 20 years, return is maximized when you have a 100% allocation to DRS. But that's really not what we're focused on here. We're focused on risk reduction. We're talking about mitigating or minimizing the risk to an existing portfolio. And you can see the standard deviation, the sweet spot's right around about a 50% allocation there. Sharp ratio maxes out around 60, 70%. And again, this is just mathematics. I mean, in the real world, we're going to have to probably figure out what the objective is and figure out what the optimal solution is. But this is just adding 10% increments to a 60-40 portfolio. Now, of course, most people don't have a 60-40 portfolio. Most people are diversified across asset classes here. So what we see here is, at its core, still a 60-40 portfolio. It's 40% bonds, 60% equity, but we've diversified within those slices, right? We've got some small cap, we've got some foreign developed, emerging markets, there's some REITs, some high yield bonds, some cash. This looks like your typical model portfolio. Well, what if we do the same thing? What if we put those 10% increments of the DRS into something like this? Again, just looking at the math here, what do we see? Similar levels, right? We're seeing the maximum benefits from a risk-return trade-off standpoint coming around maybe a 60-ish, 70-ish% allocation to the DRS. Now, there's a more subtle point here that I wanted to point out. Let's just forget about the DRS for a second. Let's take a look at the basic 60-40 model versus this asset allocation plan and compare the two of them. How much added juice, how much added benefit do we get by following the standard diversification model? Not a whole lot, right? I mean, we can take that pie and have 2 slices. We can take the pie and slice it up into 8 slices or 10 slices, how many ever it was before, and we see very little impact above and beyond the traditional 60-40 there. So this gets back to the idea of saying like, well, market risk cannot be diversified away. We can spread it out amongst all these different asset classes, but at the end of the day, when the markets crash, when the correlations go to 1, we're still faced with this problem. So our philosophy at Swan is like, look, if market risk cannot be diversified away, it should at least be hedged away. All right, that's what we've been talking about here. So if we kind of like this concept, how can we plug the DRS into an existing portfolio? I've got 5 different ideas here. Now again, these are just ideas. I'm not saying anyone's better than the other. These are just potential ways you can put it into an existing portfolio. The first would be a total portfolio solution. Second would be as a core equity. Third would be as an alternative of some sort. Fourth would be more as a systematic withdrawal or distribution vehicle. And fifth is a multi-asset class solution. I'll build out each of these in turn here. Now, as Randy mentioned, and Rob and Sean in that lunch, the session right before lunch, originally when this thing was conceived, it was meant to be a complete portfolio. We had the growth component of the portfolio as represented by the 90% long the market. The protection element that was taking the role that the bonds have historically played in the portfolio, well, that was the hedging, right? If the markets are kind of flat and not really going in many of a direction, if it were kind of a market neutral type environment, that's fantastic for the premium collection or the income portion of the DRS. So with this 3-legged stool, right, we've got different sections that are suited for either rising, flat, or down markets. Now, all of them aren't going to be firing at the same point in time. Kind of like to Zoe's point, if you have a portfolio and everything in the portfolio is up at the same time, you haven't really done a very good job of diversifying. But this 3-legged stool, there's always going to be something up and something down at any point in time, maybe something in between. So therefore, this could be viewed as a total portfolio type solution. Now, I realize that there's not many people that would put 100% of their money into a Swan type solution, but you know, what we're probably going to do is have it slot into an existing portfolio. Well, one way that we can potentially look at this is as a core equity solution. If we just look at more of a holdings-based analysis, if we take a look at the DRS and look at like how the market caps break out, what the price-earnings ratio looks like, what the price-to-book ratio looks like, all those various things that you might get out of a Morningstar, what you see is that it syncs up rather well to the S&P 500 as well as the large cap category average there, which of course makes sense, right? Because 90% of the holdings are in large cap ETFs. So if you're defining your investment by terms of what's actually the holdings are, you can certainly make the case that this is a core equity, but it just has a hedge overlaid on top of it. All right? That's one way that you can view it. It's a conservative beta-reduced version of core equity. Now, if you, however, define your products or your solutions by what they actually deliver in terms of returns, you might not be able to make this case. You might want to actually pivot and say like, well, this is more of an alternative type structure. Why? Well, take a look at these different metrics there. And someone asked the question earlier in the day, what's the beta? Well, our beta is very low. It's 0.3. The tracking error to the S&P 500 is quite high at 13.4. The R squared is very, very low. But that, of course, is by design. Because what we have here is the S&P 500, this is the market, and when the market sells off significantly, you don't want a high R squared to that, you don't want a low tracking error to that. By design, we're trying to deviate from the market during those periods. Now, of course, there will be a cost to that we won't catch all of the upside, but if you're just looking at the numbers, if you're just looking at things like these MPT statistics here when it comes to correlation, R squared, so on and so forth, yeah, I mean, these are the numbers of an alternative type investment. So you can certainly make the case that the DRS is an alternative solution, maybe even a better alternative solution. Many hedge funds, which people put in the alternative space, are expensive and illiquid, and you can make the argument that they don't really hedge either, right? They're just some limited partnership. When it comes to the liquid alt space, many people, a lot of these liquid alternative funds haven't been around all that long. Alternative is really a tricky classification, right? It's just kind of a catch-all that says if it's not a stock and it's not a bond, then it goes into this broad bucket called alternative, which could just be called other. So that makes it very difficult to kind of get your arms around this thing. But here's really the killer one. I think when people talk about alternatives, the allocations tend to be very small. At the end of the day, most allocations to liquid alts are like maybe 10%, 20%. Now, certainly in the institutional world, in the endowment model, the foundation model, they could be a lot larger. But quite often, alternatives aren't really going to move the needle on lots of people's allocations. Let's see here. So kind of build out these numbers a little bit more. Most of the liquid alt funds haven't really been around for that long. I've got some selected different Morningstar categories here, like long short, managed futures, market neutral, multi-alternative, option writing. Tactical asset allocation is not really a liquid alt, but I just threw them up there anyways. But what you can see is that, yeah, how many of these guys were actually around prior to the financial crisis? I used March 9th, 2009, say who has an inception date after this bull market took off and who was around before then. Well, you can see it was only about 1 in 5 have actually truly been battle tested. Now, maybe they've been built off a back test. Maybe the ideas sound great for some of these liquid alts. And I'm sure that when the next bear market comes, some of them are going to do great. Some of them are going to do fine, right? But there's also probably going to be some that don't live up to what they had originally been designed for. So that's one problem. Now, the other problem, as I mentioned, is that most allocations to liquid alts tend to be rather small. And what we saw previously, this is the same slide that we had maybe about, a dozen slides ago, was how much does it really take to move the needle? How much allocation you need to DRS to really minimize the losses and mitigate the risk? Well, it's not going to be 5% or 10%. It has to be a significant slug here. And not only when you look at liquid alts having a small allocation of maybe 10%, usually that 10% is split up amongst multiple managers, right? Someone says, okay, my liquid alt sleeve is 10%, but one might be managed futures, one might be long short, one might be something else, was maybe a min-vol type strategy. So at the end of the day, if the DRS only gets like a 2% slug, it's probably not going to help that much. Let's see here. All right. Now, the other thing that we could potentially do that we have seen the DRS used for is as a distribution vehicle. Now, we've talked extensively about the challenges that fixed income has faced with this low yield environment and the Fed's policies over the last 10 years. And essentially what that's meant, what the ramifications of that, is that fixed income cannot provide both capital preservation and income going forward. You know, for the last 35 years, bonds have been a fantastic investment because you had your cake and you could eat it too. You had both income and capital preservation. Going forward, or at least recently and probably going forward, it's either or, right? You have income or capital distribution, or excuse me, capital preservation. And if it's like this quarter or last quarter, you don't have either. You don't have hardly any income and you lost money in bonds. So that has opened up investors to this idea of investing in bond alternatives. It might be multi-sector bonds, it might be non-traditional bonds, it might include things like high yield, foreign developed, emerging market debt, derivatives, credit swaps, interest rate swaps, all sorts of different things here. Now, if we were to compare how the DRS has stacked up from a risk-return standpoint to some of these multi-asset bond alternative type strategies, you can see that from a risk-return perspective, yeah, I mean, we have the same kind of correlations and the same kind of up-down metrics that you would see in some of these non-traditional bond type strategies here. Now, I'm not saying that this was necessary to be like a replacement for treasuries. That would be taking this concept too far. I mean, this is obviously has different drivers of returns and is not going to take the place of just, you know, high quality treasuries in the portfolio. But that being said, if people are open to introducing other things into the portfolio to fulfill that capital preservation role, why not a hedged equity type strategy that does have explicit downside protection on the market through the purchases of these hedges? And of course, now that being said, there are problems with the traditional investment grade market as well. What we have here are the duration numbers for the Morningstar category averages for all these various investment grade and actually high yield strategies in there as well. And yeah, I mean, we started to see this manifest itself in the first quarter of 2018, that when interest rates go up, the value of bond positions, the value of them will go down. I think people put their money into bonds thinking it's impossible to lose money, but that defies Finance 101. You know, rates go up, values of bonds go down. So, you know, there's downside risk certainly on this traditional side, and that's what's led people to consider the DRS in that kind of capital preservation type role. And to show you what we're talking about here, now this is a hypothetical example. Here we're looking at the long-term track record here. Well, say for example we take $1 million and we invest it in one of three options. We're either going to invest in the S&P 500, in the 60/40, or in the DRS. And what we're going to do is take out $5,000 per month, compounded at a 2% annual rate. So the base rate's 6%, which is aggressive, and then we're going to compound that by a growing rate. And we can see what happens if you're taking money out of an allocation and then a big bear market hits. Well, you know, unfortunately, what happens here, in fact, I've got maybe better graphs for this. You can see the end values here. If you're taking out that level of withdrawals, you're starting to eat into the principal of both of these other solutions here. But because historically the DRS has done a good job of minimizing losses, we've been able to maintain purchasing power. Now, I'll admit the 6% is rather aggressive. I mean, back in 1997 when bond yields were giving us, you know, what, 5, 6%, that's what people were talking about. I don't think anyone would these days say, yeah, go ahead and take 6% out of your portfolio. And the other thing that did benefit us was like, yeah, within the first 5 years, we had that big bear market. We did do very well. So obviously these numbers are impacted by that. But that's the point, right? I mean, the idea that we've protected in down markets does give credence to this idea that you can maintain some sort of level of withdrawals here. Now, again, using this more aggressive 6% rate, here's what it looks like on the S&P 500. What we have here in red, or this burgundy color, are the withdrawals, right? So that's always going to be negative. We're always taking money out under this simulation here. And this is the S&P 500. The blue line are the unrealized gains or losses in the portfolio. And what we can see here, the green line, is the wealth that we've created here. Now, in this case, you know, I kind of pointed out that, you know, with the S&P 500, yeah, you know, you can take the money out, but you're starting to dip into principal. The other thing that popped up when I looked at this maybe about 6 months after creating this graph was this flat line here. We've been talking about the fact that the bull market's been going on for 9 years. It's the second longest bull market in history. It's up about, what, 350% off the bottom in March '09. And that's fantastic. But what if we're taking money out? Well, we're treading water, right? We're treading water here. Now, again, aggressive rate, 6%. But if you're doing something like that, you're essentially spending everything that you're making here. Now, we got the same thing on the 60/40 here, the same basic layout, but maybe a little less deviation, a little less volatility on the simulation. And historically speaking, because we've done a good job of mitigating losses, the worst calendar year was 2011 when we lost about 5.11% in the calendar year, that when we've had these losses, they've been manageable, and we've been able to maintain some degree of withdrawal potential out of this account by not losing big, not having a situation where our account value is down 50% in 18 months just due to the market movements. Okay. Let's see here. Again, that was a simulation. I don't know if it's, I wouldn't use it as a financial planning tool, but it's just meant to show the impact of major losses. Now, as I move into the last section of where the DRS fits, the other thing that we could potentially do is we could take this concept and apply it to different asset classes, right? In order to do this, in order to do the defined risk strategy, we only really need two things. We need an ETF exposure to a given asset class, and we need to have options that are liquid enough for us to do what we do, doing the hedging and the premium collection. And so we've taken this idea out, we've applied the idea of the DRS. This is our strategic vision, not only to large cap, which we've been doing for 20 plus years, but we've also been doing it with small cap, foreign developed, foreign emerging. These are all asset classes that are covered now by the DRS. Now, if we have that portfolio that we saw before, or actually this is a new portfolio, if we have like a 60/40 portfolio here, and maybe we've got some active managers, some passive managers, some small cap, large cap, foreign active, so on and so forth, what we could do potentially is we can give DRS allocations to these different sleeves here. So maybe we take a little bit away from the bonds, we take a little bit away from the S&P 500, we split our small cap, we split the foreign developed, split the emerging, and give Swan, essentially DRS versions on 5%, 5%, 25%. At the end of the day, what you could do with this is have a portfolio that's 40% DRS hedged assets, and then maintain your 60% traditional portfolio. So again, these are just different ideas here. These are different ways that you could potentially use the DRS, defined risk strategy. Probably the best real-world example I had here was from a financial advisor that used this in Philadelphia. And essentially what this guy in Philadelphia said is he diversifies his use of the DRS across different client types. And here's what he means by that. So he's got some clients who are older, right? They're either at retirement, in retirement, near retirement, and they might have the traditional model where it's 30% equities and 70% bonds. The 70% bonds is very conservative. It's treasuries, it's munis, but guess what? They're getting like a 2% yield out of that, so they're not getting a whole lot of juice. He needs at least 30% to be keeping up with inflation and generate some income. But he's terrified of the downside risk that a 70-year-old person may have with a 30% exposure to the equity markets. So what does he do there? Well, he still has equity exposure, but it's hedged equity exposure for those more in retirement type clients. Now, the flip side is he has younger clients, too. He has younger clients who might be in their 30s or 40s, and they're more aggressive, right? They're more aggressive. They're taking more alpha bets, so on and so forth. Well, what does he do in those cases? He uses the DRS as a beta reducer. He uses the DRS as a way to take some risk off the portfolio, risk out of the portfolio off the table, which allows him to then be more aggressive with these other bets for for the younger clientele. So again, this is one guy, this is one advisor who's been able to put the DRS solution into different roles within the portfolio. So with that, what I'm going to do is go ahead and transition over to the last section here, because everything we talked about, and also invite Chris and Micah up if you want to join me on the stage here, because everything that we talked about so far when it comes to defined risk strategy is it's one size fits all, right? You get all three components wrapped up into a single solution. Well, what if you don't need that? What if you're saying to yourself, well, I like some of these things, but I've already got part of my solution in place. I don't necessarily need the mutual fund or the separately managed account. So I'm going to have a couple of questions here for my colleagues, Micah and Chris, where we'll discuss customization capabilities with the DRS. And the way we're going to do that is, again, think of the defined risk strategy as this three-legged stool. We've got the equity, we've got the hedge, we've got the income, right? The equity is there for growth, the hedge is there for protection, the income is a market-independent source of returns to help subsidize the carrying cost of the hedge. But what if we break this apart? What if we disassemble this? What if you come to us and say, well, I've got a unique situation here, and the mutual fund just isn't what I'm looking for? Well, what we can do is you can break it down into its component pieces, and that actually gives us quite a bit of flexibility. Now, this is where we would encourage you to come up and talk to us afterwards and have a conversation with someone like Mason or Bob or Rob Swan or Randy, because what we can do then is we can treat each of these different pieces independently, and it gives us kind of flexibility on how much risk we want to take, right? We can think of these different components as different dials that we could turn up or turn down depending on what your needs might be. And we'll share some examples with you here, but this is just kind of a visual to help set the stage there. So what I think we'll do is we'll start off with the most basic, the simplest portion of the portfolio, the defined risk strategy for us first, which would be the core equity. And what do we do with the off-the-shelf DRS? We invest in passive ETFs. Very boring. I'm not sure if the State Street people are still here, but it's kind of boring, right? It's ETFs. There's not a lot to it. But what if you disagree with our fundamental assertion that a passive ETF is the best way to gain market exposure? I guess I'll start off with Micah. How do you want to talk about some of the different things we could do on the core side?
Yeah, I mean, I think, Randy mentioned earlier that we're pretty agnostic, obviously, to the underlying. As long as there is good liquidity in that, what's being traded in good liquidity in an option market where we can hedge out the market risk, then we can look to apply it on a lot of different things. So, for example, if someone has just a diversified portfolio, number of different assets, we can take a look at that and say, okay, well, how does this portfolio tend to act? Does it act similarly? High correlation to small cap or a mixture of small cap and large cap or foreign emerging. So we can use different building blocks to try to take a look at hedging somebody who just wants to manage an actively managed portfolio of different managers. Or another way we can look at it is if someone has a highly concentrated position in a stock. In some cases, we can look at trying to do something with that. And we can talk about that there in a minute on different ways we apply our overlay. But I think with the core equity, obviously, we take that approach of the equally weighted sector approach with our large cap, but we also run the strategy and many of our accounts that's cap weighted. We're agnostic to that underlying, and if someone has especially a similar portfolio to a major index, to a normal diversified portfolio, then that's one way we can kind of either talk with them about turning that dial up to be a little more aggressive, higher beta. For example, maybe they have a portfolio that's a little more highly concentrated in a tech sector, for example, or something that has a higher beta. Or if they have a lower beta portfolio, we can also look at that as well.
Okay, great. So, you can imagine a scenario where we talk about, dialing the risk up or down because the hedging does take, some of the beta off the table. That might allow them to take bigger bets with their equity. I mean, if they're feeling so inclined.
Right.
Okay. So I guess this situation would be model portfolations. What might be some other types of things like annuity overlay type?
Right.
Situation?
I mean, we have a number of different iterations that we've done ourselves as far as with our collective investment trust and the retirement plan space. We think obviously it can apply. I mean, for what you were just talking about, you kind of made the case there as far as okay, perhaps with a product you don't want to take too much exposure, but if you do an overlay, then you can kind of actually start to look at those types of numbers where you're reducing perhaps your volatility, your standard deviation, perhaps even incrementally improving returns. And you can kind of take a look at, well, I really like the managers I have a portfolio I have, whether it's a model portfolio or annuities that are running portfolio models, and say, well, okay, can I actually bring the risk down while also improving returns by putting something over that, using options to help change the outcome, the structure of returns.
Okay, great. I think sometimes we've also encountered, we'll probably talk about this a little bit later unless you want to address it now. Sometimes people come to us with a low basis cost individual position. They'll say like, I was an executive at such and such corporation and I don't want to sell the stock, but I want to minimize my downside risk. And that would be another form of beta, although there would be some differences when it comes to the hedging.
Right, yeah, and that's something we like to take a look at too. When people bring those types, those are fun to look at. I mean, the thing to think about on that, sometimes they might be in a position where either they're restricted from trading it, or they're big believers in the company they're working for. If it's a publicly traded company, a lot of times we can take a look at different ways of hedging out some of that risk for them and try to do something different.
Okay, great. So again, I mentioned that the equity portion of the portfolio was the least exciting. Let's get to the sections where Swan really brings a lot of expertise to the table, which is the hedging, and then after that, the premium collection. And if you guys wanted to use any slides here, that's fine. Now, when it comes to hedging, the baseline solution that the DRS offers in our off-the-shelf, one-size-fits-all is this idea that we're always hedged, right? That we've always got that protection in place, that we're using long-term puts to minimize the costs and have the re-hedge potential, so on and so forth. I mean, you've heard all these things before. And also that we're protecting, either at or near the money. When we put that original hedge on, that it's going to be close to wherever the market is. Now, one of the knocks that we have on our off-the-shelf solution is like, well, that can be expensive. Even though you're doing things in a very cost-effective way by rolling out of the hedges later, it's still too much of a drag. I'm paying too much for that insurance. Chris, what kind of options, no, I didn't mean that sound that way, what kind of potential solutions do we have when it comes to hedging when we start unpacking the box here?
Sure, so the first thing you have to assess is, well, what's my problem, right? Am I worried about left tail? Is it moderate downside? Is it a grind lower? Is it maybe yield that I want? Is it a grind higher or even a right tail? So when you're employing options in a portfolio, what are you trying to do? Well, you're trying to adjust the distribution of returns. In other words, hedges allow you to stay in the game longer, so that way you can have a better capture ratio on the upside, have a better capture ratio on the downside. So what we're looking at here is just basic hedge strategy comparisons, right? The long put, a put spread, a collar. For those of you that don't know what a collar is, it's buying a put, a downside put, so you're buying insurance, and you're funding that by selling an out-of-the-money upside call. And then a put spread collar, which combines a downside put spread, again funding that with an upside call, and then a 1x2 put spread, meaning we're going to buy one put that's closer to the at-the-money, and then we're going to try to sell two puts that are out of the money, hopefully to try to reduce the cost. So I have a saying that every hedge has its day, and what you have to decide is, well, what type of scenario am I trying to hedge out against? And so there's this word that I always use, it's called convexity. Is convexity your problem? Do you need to have short-term, are you worried about violent 1 week, 2 week downside moves in the marketplace? Or are you worried about the larger bear market that could last many, many months, if not years? So what we have here really is just a basic comparison of, if I decided to hedge with a put spread collar, what are the pluses and minuses to these? So obviously with a long put, you're going to have loss of premium in a bull market. One of the things, there's a difference between a cost of a hedge versus how much you lose in a hedge, okay? And that's something that's very important, especially with what we do with the 2-year leap. We may allocate a certain percentage to purchasing that hedge, but the drag is much, much less than that. As opposed to a short-term option, your typical 5% out of the money option that's readjusted on a quarterly basis usually costs you anywhere from 6 to 8% per annum. Now what if you had to reset on February 5th or February 8th? That was going to cost you about 30% per annum on that day. So there's call it the running cost of the hedge. So when you do shorter term hedges, one of the issues is managing the running cost of the hedge, because like I said earlier today, it may be time for you to re-hedge, and it may be in the middle of an event, okay? So I don't personally look for the gold metal hedge. I don't look for the silver metal hedge. I look for the bronze metal hedge that's always going to be there and always going to be consistent. Put spreads are good, but that's going to offer you partial protection, okay? It's not going to give you full protection to the downside. So once you reach full protection on the put spread, then you have zero protection past that. So you're subject to left tail events. Collar has full protection, but you're going to be truncating your upside. Put spread collar, again, truncation of upside and only partial protection to the downside. And the 1x2 put spread, which is very popular, unfortunately, this is one of those strategies that has a what? A net short unit, okay? A put is not net short, the put spread is not, the collar is not, the put spread collar is not, but the 1x2 put spread actually has a net short unit. So there's a hidden risk that you have to analyze when you're trying to do these types of strategies. Again, these are just basic hedging strategy comparisons and kind of what the pros and cons are to each.
Okay, great. Now, this idea of using shorter term puts and kind of a rolling basis, I mean, it seems to me that would be more conducive if someone wanted to do like a risk on, risk off type of approach. I mean, again, Swan's approach has always been always invested, always hedged, but for someone who might want to be a little bit more discretionary in terms of their hedging, using short-term puts might be a solution.
It definitely can be. I mean, again, it depends on what problem you're trying to solve with your investment portfolio. So this next slide really is kind of taking the basic ones that we looked at, and well, when we're looking at a hedge, we can also incorporate some opinion, right? We've got a market opinion, directional, right? Do I think the underlying is going to go up, or is the underlying going to go down? But then when we're dealing with options, we always have to do some type of assessment with volatility. Is volatility high or is volatility low? Okay, so we need to. It's not just a volatility game; it's also a directional game to try to pick out what the best, in most cases, what's the best hedge in most cases, right? Again, it's not going to be the gold medal winner, but the one that's going to perform over the long run over and over again. So if yield is what your objective is and volatility is high, well, there are strategies such as shorting straddles or long butterflies, okay? I know many people may not know what I'm talking about, but we're just kind of laying out some basic strategies. And vice versa, if implied volatility is low, well, shorting butterflies and long straddles would be something else that you could do. So if you have a bearish market view, then you can kind of see the different types of strategies you can employ under high implied volatility or low implied volatility. So when volatility is very, very low, well, you should be looking to do outrights. If you should be looking to do shorter term outrights. Again, there's the risk, though, of managing that cost of the hedge. If your market outlook is bullish, well, then there's other things that can be employed: call spread collar, risk reversals, long calls, call spreads, et cetera. So this is just an example that there's a lot of different hedges out there available. And again, it's really deciphering what problem you're trying to solve and what the market environment is.
Okay. Yeah, let me throw in a couple other potential things that you could potentially do on the hedging side. I mean, again, the baseline way that the DRS operates is that we invest fully, cover the full notional value of the portfolio, the long portfolio, and we do so at or near the money. So, like if the S&P is at, say, 2,600, the puts that we are buying are at around 2,600. How can we turn that dial either on the notional side or on the strike price, and what are the pros and cons of playing with that dial?
Yeah, I mean, strike price is, again, if you're changing or maneuvering your strike price around, you're affecting your deductible, okay? The good thing about there's not that much a big difference when you're doing longer term options. That deductible could be material, though, if you're dealing with short term options, especially, if you're in the middle of an event. I mean, if you have strategies that are hedging that are 5% out of the money and they're shorter term, well, there's the other thing is the stair step down effect, right? You have a hedge that's 5% out of the money, reset on a quarterly basis, very systematic. Well, what happens if the market's down 4% every quarter? Nice and steady, down 4% every quarter, down 4% every quarter. Well, that hedge that you have on didn't do anything for you. So that's one of the risks when you have to analyze hedges and actually ask, well, what is my problem? What am I trying to solve here? And is this the most appropriate hedge to solve that problem?
Okay, great. Well, let's talk about the third. I know we're going to talk about the overlays, but let's talk about the other piece of the puzzle, the third leg of the stool, which is the premium collection, which is, again, our bread and butter trade is selling both a put and a call simultaneously and collecting, a modest amount of premium to help offset the carrying cost of the hedge. Now, that is a portion of the DRS that sometimes people, it's harder for them to come to terms with, and there are periods where, in a short time span, that those trades go negative. So, what kind of again, options do we have on that third leg of the stool, the premium collection, if we wanted to do something different, or if the client, wanted something different?
Well, it depends on what kind of risk tolerance you have. I mean, there's premium collection strategies that are capped risk, such as condors that were mentioned earlier. Obviously, you're not going to collect the amount of premium that other type strategies, such as short straddles, which is a pure volatility play, or short strangles that take in a combination of volatility and the differences in skew. So again, you have to go through a checklist of all these things to assess in the marketplace. Obviously, if you want more income, you do more options, right? That's what some active managers can do, okay? i.e., right, leverage. So there's ways you can really dial it up, and it depends on what kind of structure you have. Are you using portfolio margin? Are you trading options on futures where you get span margin, more bang for your buck? So there's other ways that you can definitely ramp up the risk if that's what you want to do in a portfolio.
Okay, great. So yeah, those are the different things, potential things that we could do when it comes to the different three legs of the stool here. So like, how would we see this, manifest itself either in like a total portfolio solution, or if someone has that has maybe an individual stock that they come to us with? We want to come back to that idea.
Yeah, we've got some examples here. I mean, when we talk about our overlay, which is what we're kind of talking about here. We can listen to a client and try to figure out what fits them best from a risk-return standpoint, risk-reward standpoint. So what we're looking at here is just kind of a visual example of that. Let's say somebody has a portfolio there of alternatives, fixed income, equity, and they're looking to perhaps try to manage the volatility in the equity portfolio, the portion of the portfolio that's in equities. Perhaps they feel like the market's run too high, or they have really big gains in those positions. They don't want to sell them. Then we can look to try to reduce some of the risk there, perhaps bring that down through the overlay. And we actually have a number of different ways that we can apply that. And here it's just kind of showing that depending on where they're landing on the risk, on a risk profile, it's going to say, well, we can either do something like in a basic portfolio or a concentrated position that's going to be more trying to bring the risk down to be more of a conservative portfolio, if that's what they're looking for. Or if they're just looking to reduce tail risk, then we can try to look at a more customized hedge. As Chris was mentioning, the different types of hedges that can be used. I mean, say if you're only worrying about this type of a sell-off, well, then we can try to structure the hedge in that particular way. But there's a number of different building blocks we'll use for that, and some of the ones we'll use obviously are the ones we mentioned earlier: large cap, small cap, foreign developed, a few others. We also do one on high yield bonds. But we saw this graph earlier. The way we kind of a visual of what we're talking about here to really adjust to the risk profile, right, for the investor is to go back to our target return band that you've seen a couple of times today to set what this looks like. You have here the SP 500 with the red line there, and then kind of the underlying equity plus the hedge is what you see there with the gold line. But if you look at this slide here, as we're talking about here, in an overlay, you can choose to dial that risk up or down. So the at the money you continue to see there, but now we've added here a little bit further out of the money hedge, long-term hedge, just kind of, again, thinking over of a 1-year time frame, or a little bit less than 1 year in this case here, and then a further out of the money put. So what do you notice from this? Well, what you see is, think of it as a deductible. You're increasing your deductible. That's on the left part of the slide there. You see those lines starting to go further down on the risk spectrum. What do you see on the right side? Well, you see it starting to get a little steeper, right? So your exposure to the market as the market moves up is higher, so you're getting potentially higher up capture, but you're of course going to pay a little bit more on the downside, so to speak, with your deductible. And we like to use that deductible example because if you think of a medical insurance, you say, well, how big is your deductible before the protection really kicks in? And if you're willing to take on a little bit more and you're comfortable with paying a little bit more deductible, you're going to be paying less premium, right? Probably your premium comes down on what you're paying for that policy. Well, in the same case with options, well, if you go a little bit further out of the money, you're not going to have your protection kick in as soon, but you're also going to be paying less premium for that option, which means you're going to have a little bit higher on the up capture. So there's a couple of ways that we've actually already implemented this. One other kind of thing I want to add to this slide here, which I think is one of my favorite iterations that we do in more customized DRS approaches, is taking one of these approaches here where you're spending a little bit less on the protection. If an investor is willing to take a little bit more risk, maybe they're a little bit more aggressive. And then actually, as Sam and others talked about earlier, you also have the right tail risk that you got to think about, right? And actually putting and adding to this position a right tail hedge, as we like to think of it, where you can buy an out-of-the-money call spread, which then increases your upside capture even more. So in essence, you're saying, I'm going to spend a little bit less on protection. I'm going to take that money that I'm not spending, and I'm going to spend a little bit on additional exposure to the market. So now I'm going to potentially get more of the market if it takes off and it goes up a whole lot. But I'm also going to be okay with the fact that maybe my downside means I participate a little bit more before the protection really kicks in.
Can you actually go back before you go to the next slide, go back to our basic target return band? Okay. Again, this idea of the target return band is one of the key drivers of the defined risk strategy because it essentially contains all three elements, right? All three legs of the stool. That diagonal, straight diagonal line, that's the market line. That's the core equity exposure, right? That hedge is the gold line is the impact of overlaying the hedge on the equity. And then that blue band of uncertainty is the impact of the income trades, right? So think about it this way. We could dial up or down any of these different elements here. If we wanted a high beta portfolio, what would that look like? Well, the steepness of that diagonal curve would change, right? If we have a more aggressive portfolio, we get more, upside, but more downside. We could go a low beta portfolio, like maybe 0.7 beta. That curve, that diagonal line will be flatter. That's the first dial, right? Now, all these cool ideas that Micah and Chris were talking about, that would change, the shape of that curved line, the gold line there. And then, when it comes to the income trades, if we wanted to do something like Chris mentioned with having condors down there, well, that's going to truncate that blue band. We would have less upside potential, but less downside risk there. So all these different elements are things that we can modify. And again, I just want to get back to the idea that we're a $5 billion company, and we've got most of those assets from providing a basic off-the-shelf solution to a broad client base. But once we start expanding into more institutional type solutions, these are all things that we could potentially tweak up and down the risk spectrum. So, and you've got a great example of that with the CITs coming up, right?
Yeah, and so this is something we've actually already done in conjunction with a great partner, Gordon, out in North Carolina. And these are collective investment trusts where we're taking this concept, exactly what we've been talking about, of building this idea of defined risk strategy across different risk profiles. So these collective investment trusts have been running for a couple of years now, about $265 million in these collective investment trusts. And they basically are, similar to, you might think of almost like in the target date fund space or something in the 401k space where you're able to get a model portfolio that fits somebody's risk profile or where they're at in their retirement or their age. So on the left side, you'll see there's a good bit in bonds, and then we have the DRS there only at 30% of the portfolio, and then it goes up to 50% in the conservative. And then you have our traditional kind of, as Marc was just talking about, our at-the-money hedge approach, what we've been doing for the last 20 years there. That's that moderate model. And then this moderate growth and aggressive growth model you see to the right, this is where we're really applying a lot of these things we've been talking about as far as a multi-asset approach, where maybe you've increased your beta a little bit by what your underlying is. But then we're also going a little bit further out of the money with the hedge. So we're spending a little bit less hedging. Now, what does that mean? That means these are going to have a little bit more risk to the downside, right? They're always still invested. They're always still hedged. Think of it again as we just saw right here, larger deductible. And then also the more aggressive one, going even a little bit further out, adding some other higher beta asset classes there with like U.S. technology, more to emerging markets, for example. Now, of course, those strategies are still hedged, but instead we're taking this approach of, okay, well, if we spend less on hedging, we're okay taking a little bit more of that risk. If somebody has either a longer time frame, if they're a younger investor, or they're just willing to take a little bit more of that volatility. So what you tend to see in these types of portfolios is a slight increase in volatility, but potentially, of course, it depends on what happens with the market. You can have higher returns, or even the more conservative ones, of course, can win out if we go through a big bear market because they have more protection, right? But if you're going through a bull market, you can still actually have very good participation with these while still being fully hedged. So for example, the aggressive growth model last year was up about 22%, with the stock market up about 21%, but it was also fully hedged the whole year. So that's just an example. Obviously, it did have some other asset classes there in it with some of its positions. And another, last kind of real example that I can give as far as what we're doing on this type of approach is with our LP that Jamie mentioned earlier that we have, where we're taking all the different DRS asset classes. We're running 7 different DRS strategies within that fund, and then having the ability to, at times, if we want to, we can run a more aggressive version like what we're doing in these CITs. And so we think, of course, the underlying, we're agnostic about that. There's different ways we can build those things, different ways we can build the multi-asset approach. There's lots of different ways we look at putting those building blocks together, but what we always come back to is you can mix them up all kinds of different ways, but the more important thing is adjusting your risk, right, through the hedge and how you're doing that.
Okay, great. Yes, I mean, that's the kind of idea that we have here is that you do have flexibility when it comes to these different elements. So come to us, have that conversation. I wouldn't expect anyone to come up and ask for, hey, I really like the idea of a broken wing condor. It'd be more like, hey, I need this, I need that. This is what I'm trying to solve. So have that conversation with us, and we'll give you some different ideas. Any questions about this last hour or so that we spent on implementation, either with the standard model or with the customization? Of course, we're going to be available afterwards to talk as well. But any questions on this last section? Yeah, I mean, I guess the situation is, when are people willing to take bigger risks? It's like, if they want more of the upside, they want some degree of protection, but don't feel, they feel that they're okay bearing the first tranche of losses. And of course, the trade-off is that, well, if the markets are up, you're going to get a higher up capture ratio. So again, we can tailor these things to the specific scenario. This was a situation here with these CITs where, these have been designed to have a higher up capture, but more downside risk. And again, they're trying to follow the target date fund type approach there in the retirement space.
Yeah, I mean, our approach there is to try to be consistent, obviously, with our investment philosophy, right? So we want them to feel, even if somebody feels like, hey, I'm willing to take on more risk, we're still going to say, we don't know when the sell-off's going to happen. We don't know when we're not market timers. We're not going to call the market and say the market's going to go down right now or next year. So that can be where they can really take a view and say, you know what, I really want to be more aggressive, but we're also going to say, okay, well, we're going to keep you hedged because we don't know when that big sell-off's going to happen. It's going to happen at some point. And so really the idea behind the DRS and all of these is to avoid large losses. Now, of course, whether that loss is if the market goes down 40 or 50, and one person goes down 20, but another person goes down 15, or another person goes down 10, that's still way better for them, right? As long as they avoid a good chunk of the large loss, that means on the upside, they can catch up much quicker. The math works in their favor, so forth.
Okay. I believe there's a question over here as well.
Yeah, when you start blending the different DRSs, in particular developed international and emerging markets, what sort of diversification benefits do you see there? Is it pretty much in line with with just your equity diversification benefits, or how do those funds play together?
Yeah, very similar. I mean, as far as if you look at a multi-asset portfolio, you get benefits, right, from diversification. Obviously, over the last 5 to 10 years, that's been a little bit less as the correlation's been a lot higher if you look at the last 5 and 10 compared to, say, if you look at the last 20 or 30, where it used to be the asset classes would tend to move a lot more differently, whereas in the last decade after the financial crisis, most asset classes have tended to move very similarly. They've had higher correlations. So you still have some benefits there. You have the markets obviously doing different things at different times. So if you think of just a basic multi-asset portfolio, right, generally you tend to perhaps give a little bit up on return, but you also tend to bring the standard deviation down. So with the same concept, then when we apply the DRS on top of a multi-asset portfolio, you tend to either, perhaps you can get similar returns, might give up a little bit of it, but you're also going to bring the standard deviation down probably a good bit as well. And then, of course, you can kind of get into this idea of either tweaking that depending on how much of an asset class you can take. Because I can tell you, there's not probably many model portfolios out there that are taking, say, 15 to 20% positions in emerging markets, right? It's just too volatile an asset class for them. And so they might take a 5% position, or if they're heavily overweighted emerging markets, maybe it's an 8-10% position, right? And so with the DRS, because we're bringing that volatility down on that, we're able to take a higher position to higher beta portfolios or asset classes like emerging markets or technology. I think they are QDIA. Jamie knows
Each of the CIT funds are QDIA eligible for K plans. And the track record, we got a little over 2 years there. And the results have been pretty much what you would expect across our other assets. It's, in many cases, in some cases it's better, particularly on the more aggressive end. On assets, we have about 270 million. I wish I had billions. I wouldn't stand here. I'd have retired a long time ago.
Yeah, and the 270 million, they're spread across different models, but each has a benchmark that's similar to like a target date vintage year benchmark, so 2020, 2025, 2030.
Thank you very much, gentlemen.
Thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.